Looking at the CME FedWatch tool this morning, seeing a more than 90% chance of a hike coming up this month. But at the same time, we had Austin Goolsbee right here on CNBC saying, expect 2 more hikes, but it may not come in July, and he believes we can still achieve a soft landing with those 2 more hikes. What's your take on all this, the prospect of a hike this month and also 2 more hikes this year?
Well, first, I think the market is right. More likely than not, they will see the hike this month, and more likely than not, they will see 2 more this year. What drives me to that conclusion is while the labor market data were a little weak in terms of the number of jobs created, people overlook the fact that the average hourly earnings number that came out last Friday was relatively strong, suggesting that there's still some wage pressures, and that is what the Fed has been focused on. So I think they want to get ahead of that as much as they possibly can. So I think 2 more, including 1 in July. All
right, so you're looking at the wage numbers in the jobs report. Another thing people are looking forward to is obviously CPI as well as PPI. I want to bounce this off of you. Looking ahead to Wednesday's CPI report, in June of 2022, we saw CPI at 9%. Forecasts are for this month to drop to 3.1% year over year. If we're in line, maybe even below forecast, we're showing the audience right now a graph of the CPI numbers declining very steadily. Does that change the likelihood of a hike at this month's meeting?
I don't think so, for 2 reasons. First, if you looked at the minutes from the last meeting, there are a few members who thought that they should have gone the last time. I don't think those members have changed their points of view based on the incoming data. Secondly, it's the core number, the core inflation that has been problematic from the standpoint of the Fed. While headline inflation has been volatile, unfortunately moving down, the core has been relatively sticky. And so that's what they're looking at. And that number for the core has been in the 4.5, 4.6 range, far above the 2% target. So I think things are still set up for the Fed to move, even if we get some surprisingly good news on the headline number.
All right, also looking ahead, we have earnings this week, a lot of big banks reporting. Is there anything in those reports that might influence the Fed, either to not hike or maybe even raise the hike? Heard some people on Friday talking about the possibility of a 50 basis point hike.
I think 50 basis points would be unlikely, well, not impossible. That does not seem like the likely move this late in the cycle. And as you point out, inflation has been coming down. They do want to make sure that they see inflation still coming down lower. Vis-a-vis the question of bank earnings numbers, as you know, there's a question of fragility in the banking system in general following the crises of earlier this year. So I think they'll be watching that closely to gauge the bank fragility and the state of the banking sector in general.
All right. Roger, please stay with us for a moment. I want to turn our attention back to the financial sector. Second quarter bank earnings, as I mentioned, kicking off later this week. We have a new report live on CNBC.com right now, laying out why the U.S. banking landscape is, quote, on the cusp of a seismic shift. And joining me now is CNBC.com banking reporter Hugh Sun. Hugh, good morning. Always great to see you on the banks. Give us a sense. Regional bank stocks are down more than 20% since SVB. Big banks nearly 15%. Is that the catalyst for what you're saying is this seismic shift?
Good morning, Frank. It's great to be with you. The stocks being down since March, it's one sign of the pressure the industry is under, but I think it's helpful to zoom out for a minute. The history of banks in this country is that there are periods of stability followed by periods of stress and consolidation. And the fact is we are in one of those periods of instability right now. So obviously we had SVB collapse in March, and then things seemed to calm down after JP bought First Republic in May. There is, however, a lot going on under the surface, and I think you're going to see some of those signs of that when banks start reporting this month. So rates obviously have climbed harder and faster than anyone's experienced in 4 decades. They're probably not done rising yet, just as you guys have spoken about. Commercial real estate defaults, that's coming. And on top of that, regulators who were asleep at the wheel when it came to mid-sized banks will look to correct some of those errors with hindsight. So we have a situation where most of the banks in this country will be under earning stress for the foreseeable future. And it's also happening during a time when they can't easily issue new stock because the long-only players are staying on the sidelines when it comes to banks. So that has implications. There are about 4,600 banks in this country, as you know. It's more than the rest of the G7 nations combined. And one estimate from the people I spoke to for my story is that that number will be cut in half over the next decade. So that's 2,300 banks that will get absorbed by other banks in the coming years. And most everybody I speak with, Frank, thinks there's going to be a wave of consolidation that occurs at some point.
Yeah, I mean, I think when SVB collapsed and we saw some of these banks get acquired, a lot of people didn't think that was the end of the story. It certainly doesn't seem like it is now. Hugh, please stay right there. I want to turn back to Roger Ferguson, who is still with us. Roger, you just heard Hugh kind of break down the situation with banks. A lot of people believing that banks will literally be cut in half by about from 4,600 today to maybe down to about 2,300. What's your take?
Well, let me focus on the first part of what I heard him say, which is, in fact, with rising interest rates, with uncertainty in commercial real estate, I think there is stress in the banking system that is yet to play out. So I would observe and watch closely over the next several quarters to see how that unfolds. When I started thinking about banking situation in this country many, many years ago, we had over 10,000 banks. So it wouldn't surprise me to see a continued consolidation. A question on my mind that maybe a reporter can answer is, how do you think regulators are going to think about this? Because there's a concern about concentration in a small number of large banks versus the health of the regional and smaller bank sector. And so I think this notion of concentration may limit to some degree the ability to have as much consolidation as perhaps some of the observers are thinking about.
So Hugh, over to you.
Yeah, no, Mr. Ferguson is right. In my discussions with executives, they don't want to go through all the trouble to go along and make plans for either an acquisition or selling themselves without knowing that it's going to go through. So what they're looking for is clarity from regulators. Now, from up top, Secretary Yellen has indicated an openness and a potential need for these smaller banks to scale up, to consolidate, to purchase each other, and so that they'll have a bigger revenue base to try to, use some expenses to adhere to these coming regulations. So there is reason for optimism. On the other hand, you have heard folks from DOJ, for instance, talk about antitrust concerns. So it's still confusing. I think the thing that resolves this confusion, gentlemen, is that if you see a couple quarters where the banks, and particularly the regionals and the smaller banks, are under duress, that there's going to be a groundswell for consolidation, and that's going to start to happen.